Today we're tackling a question that's especially important for retirees. Is having investments in stocks too risky? If you're approaching retirement or already retired, you've probably heard conflicting advice. We'll explore why stocks are considered risky, what risk actually is, and weigh the pros and cons of holding them in retirement, and finally discuss strategies that could make stocks a bit safer for retirees.
All right, so Spencer, today we're going to keep talking about stocks, and specifically we're going to look at, are stocks too risky for retirees? I think when you look at the financial media landscape, you can get a total contrasting picture, whether you're listening to one or another media source. So let's first talk about what makes a stock risky or stock fund risky.
Well, stocks go up and down, they're volatile. And whether we look at an individual stock or even the diversified portfolio of an entire stock market, like the US, we have over 3,000 companies that are publicly listed. Even with a lot of diversification there, we still see stocks go up and down, the stock market go up and down. So by one definition of risk, it would be the volatility, the ups and downs, the sequence of those returns that move up and down rather quickly compared to other types of investments that would be considered risk. Right. One of the things that oftentimes clients would come to us with is say, I don't know how long I have to live. Mm-hmm. If I see another downturn in the stock market, will I have time for my portfolio to recover during my lifetime? Which is a reasonable question. In the last 25 years, we've seen the stock market drop almost half one time and over half another time, and take somewhere between 5 and 6.5 years to recover in those times, depending on how you do the statistics and counting and such. So as we look at that, we recognize that it's a good question, but what we try to do is take that question and really position it in light of what risk is. And we would define risk as the potential that you don't achieve your long-term goals. Mm-hmm. And when we think about long-term goals, if we have someone that we're working with who's in her 90s and she says, well, I'm probably not going to live beyond another 5 or 10 years, then we have a finite time there that's shorter. For a lot of folks who are approaching retirement, though, it's quite a different conversation because they may be in their late 50s or early 60s, and now we're looking at 3 or even 4 decades of potential there, which the risk of not achieving the financial goals there might be that we don't get enough growth in the portfolio. So we really have to define what are we looking at? Are we looking at just risk as defined by the ups and downs, the magnitude of those gains and losses at different moments? Or are we thinking about it instead in terms of not achieving a financial goal?
Right. Well, and I think we have to come back and we look as financial advisors and we say, when you take a financial risk survey, it gives maybe a very one-dimensional snapshot. Right. Where the life of an investor is really complicated. It's complex. There are multiple levers that are being pulled. And even as we look at risk, there's 2 types of risk that investors face: sequence of return risk and inflation risk too. Mm-hmm. So do you want to talk us through those 2 and how they impact retirees?
Yeah, so we not only have the ups and downs, so the volatility that we talked about that is what people a lot of times have in the back of their minds as risk, but we also layer that on in terms of the timing of that. Because we would tell clients as we sit down, you're going to face times when the stock market drops into a bear market. If history is any guide, every 5, 6, 7 years, we're going to have, on average, a big drop in the stock market. It might not be a 50% drop, as we've seen a couple of times here over the last generation, but it will be some kind of a substantial drop. If we think about that, though, if that happens and the recovery takes a long time early in your retirement years, then you put the waning retirement years potentially at greater risk because you don't get as strong a return early. Those early returns are important. So that is the sequence of returns risk, is that if you have, let's just say you retired in 2000, from 2000 to 2012, in the US, we really didn't have any rate of return in the broad stock market there because we had a drop from 2000 to 2002. Then we had another one from 2007 to 2009. And in 2012, we were just getting back up to that high water mark that we had hit in 2000. So 12 years of no rate of return with distributions in retirement put some people's retirement in peril there. Whereas if you retired in 1980 and we had a 20-year bull market, where the rate of return on average in the 80s and 90s in the US stock market was something like 17 or 18%, that's quite a different sequence of returns. So we layer on volatility with sequence of returns, and then that final one, the inflation side of things. If we have higher levels of inflation, we really need to have growth in the portfolio to offset that. So, if we have inflation that might be 3 or 4%, then we need a rate of return sometimes that at least would give us that real rate of return that's above and beyond that. We don't want to pair a higher level of inflation with a lower rate of return in fixed income and be actually underwater, have a negative real rate of return there. Yeah. So stocks historically, at least, have given us over long periods of time, it stacked the odds in our favor to have a higher rate of return with stocks.
Right. Okay, so let's now shift over, now that we know some of the risks, why some retirees avoid stocks altogether. So a couple of categories that we've put together: preserving capital, income needs, psychological factors. Talk us through starting off with preserving capital. Why is that a reason why you would avoid stocks?
Well, for some folks, they say, I've really worked hard for these investments and I've saved diligently over time. For some people, they've actually gotten to a point that between Social Security, maybe pension, maybe just the sheer volume of the savings that they have or the frugality with which they live, they don't need a high rate of return on their investments. Maybe they say, a money market investment, a CDs, if I can just over a long period of time come close to keeping up with inflation, I'll be fine. I don't want to wake up one morning saying, how much did I lose, over the last month or the last quarter? If you only invest in money market investments, if you only invest in CDs, you're very unlikely to see investments go down in value. Right. So there is that element that some people have already saved enough that they don't need the rate of return, and some people, they just look at it and say, I don't want to ever see an account go down. So that's one of those areas.
Yeah. All right, so let's talk about income needs. So these are, people are taking distributions in retirement from retirement accounts. Talk about income needs and why that's maybe a reason folks would avoid stocks.
Well, stocks are going to go up and down. Income is an interesting thing. Some people want to have a consistent level of income, and some people would actually trade the investment portfolio maybe that they built over time for a steady level of income through some kind of guaranteed stream, like an annuity or something like that. Now, we're not, advocating for that path, but there are folks that say, okay, I've built to this point. I want to make sure that I've got enough for the rest of my life. And so I want to have that consistent, steady income stream. I'm more than happy to trade the ups and downs and the potential for a higher rate of return for the certainty that I'll have enough, over time. The other way that they might do this is they might do something like a CD ladder that they build out over time, where they know they have a certain amount of income, they have security of principal via FDIC insurance or something like that. So there are ways that people can meet that income need and do so in a way that is not fluctuating like stocks would give. Now, the flip side, of course, has been, the last 100 years, if you invested in stocks and you saw those dividends of those companies in aggregate grow over time, that's going to be a tremendously high level of income over time that's increasing, but there's less certainty, of that.
Right. Okay, so that last one that we touched on earlier was psychological factors. And you kind of walked through these a little bit, but there's a reality that it hurts more to watch my accounts go down than it feels good when my accounts go up. So talk a little bit more about the psychological factor of why to avoid stocks.
Yeah, I mean, researchers go back time and time again. And these are folks all over the world, all over the US, a tremendous number of different time periods that all show that you've got something like 2 times the emotional feeling of loss, 2 times the intensity that you feel for losses, in a negative way than you feel for gains in a positive way. So losses essentially hurt twice as much as gains feel good, there. The psychological factor of this really can't be overstated. Sometimes we will sit down with folks that they just really don't want to see that statement go down. They don't want to see their accounts go down. And just even the idea that they could have 10% of a portfolio or even 5% of a portfolio in stocks will draw their attention in that direction, will keep them focused there, and they will be so much more likely to sell at an inopportune time. So the thing that hurts us most is buying high and selling low. We would far rather just take a consistent level of income, even if it needs to be in CDs or money market or very plain vanilla bonds that might not give as high a rate of return, and just accept that, then try to get into investments where we're setting someone up for a difficult ride where they're going to be very, very tempted when that stock market does go down. Because history would suggest it's going to go down.
Yeah.
And it's going to go down in a significant way at some point. It's going to be the first time it's ever happened in this particular way.
Yeah.
And so there's going to be all kinds of rationale of why they can say, I should be selling right now because this country has never invaded this country, or this political leader has never been in power, or whatever it might be. And it's true. This is a unique circumstance in history. However, if we know that these things are going to happen, and we know that they're going to eventually push the stock market down, we need to be prepared and just be able to take a deep breath and stomach that and wait for companies to be able to figure out how to navigate this environment, how to increase their profitability, and get back to where they were. Right. But if the psychological factors are so strong, they can outweigh the investment value of stocks, because even if stocks give us twice the rate of return of bonds over a long period of time, if we're not invested for a long period of time, if we sell out at market lows and only buy at market highs, then our rate of return is going to be severely hampered.
Right. So Spencer, we've talked about some of the downsides of keeping stocks as a retiree. Let's look at some of the benefits that you have of placing stocks in a retiree's portfolio. We've talked about the potential for growth. If you've got 20 or 30 years, you're going to need some growth in your portfolio, likely. If you need inflation protection, then stocks are a really good place for that. What are maybe some others that people maybe aren't thinking about or that we haven't touched on yet?
Well, as we look at it, one of the things is that time horizon and that capacity to handle risk. So even if a client does not necessarily need growth in a portfolio, even if a client looks at their portfolio and says, I'm unlikely to take distributions from this. If they look and say, I probably, I've got 15, 20 years before I would ever tap into it, it can be a legacy, passing on those resources. So we joke with clients that sometimes they're getting greedy for the grandkids because they're investing in an aggressive way that is going to go beyond their lifetime in all likelihood. So there are clients who we serve who are in their 70s or 80s or even 90s, who all of their income needs are taken care of by pension, Social Security, maybe other types of income streams there, and they don't need a certain part of their portfolio or maybe all of their portfolio. They actually don't need those returns from there. So if that's the case, then they can be as aggressive or as conservative as they deem is reasonable. And if they're very, very aggressive, then they're looking for growth, they may be passing on far more to the people and the charities that they love. Right. So we've got, again, folks that are in their 80s or even 90s who the bulk of their portfolio is in stocks because they say, I'm not going to need these. I want to be able to pass on as much as I can. And so we don't want to just go with a rule of thumb that would say, well, every year that you age, you should probably take a little bit from stocks and pull it into bonds. Sometimes it's the exact opposite, because a client gets to a point where, say, they get to 70 and they turn on Social Security and they've got a really strong income stream. And between that and pension, they're not going to need distributions likely from other sources. Why, they might be able to be far more aggressive at that point in life because they've already handled all of the distributions that they might need from a particular account. So we don't want to just go with conventional wisdom that would say, from financial media oftentimes that would say, well, we need to get a little bit more conservative every year. No, we need to go back to your financial plan and see what's your distribution plan likely to look like over the next 5, 10, 15 years, Do we need to adjust your asset allocation, whether it's for the psychological factors or whether it is for just the fact that we don't see as many distributions coming? We see that going both directions because sometimes as folks age, they say, I just don't want to take on as much risk. I don't want to have the potential, even though I don't need the income, I don't want to have as much potential to see loss at this point in life. I want it to be much simpler. Right. Okay, great. Yeah. That's a psychological factor that can be very valid. The other side of things, of course, is that they might say, well, I've taken all the trips that I'm going to. I'm not going back overseas. I'm not going to take any, expensive vacations from here on. I'm 87 years old. Let's be as aggressive as I can, with those investments because I don't need the distributions anymore.
Yeah. No, that's good. Okay, so let's now talk about if you are wanting to still be invested in the stock market, but you want to maybe reduce some of that risk. What are some ways that we can reduce the risk of either that sequence of return risks or some of the inflation risk, but still be invested in the stock market?
Well, we always come back to one of the first things that we need to do. We need to have a primary reserve that's healthy. Oftentimes in retirement, that's 6 to 12 months of living expenses. But beyond that, we really need to look at our distribution path and say, how many years of distributions would I like to have in fixed income? If we have 8, 10, 12 years of distributions sitting in treasury bonds, let's just say you're going to take $50,000 a year to supplement Social Security and pension income, and you want to be able to do that on an inflation-adjusted basis. If you need to take out about $50,000 a year in today's dollars, you might need $500,000 plus or minus, they're in fixed income to be able to deal with all of those distributions. We want to make sure for the vast majority of clients that if they're in retirement taking distributions, that they've got some number of years in fixed income that are earmarked so that they can take those whether the stock market goes up or down. They're not tied to what's happening in the economy. Now, of course, treasury bonds can go up and down, but if a treasury bond goes down in terms of its price, the effective yield on that is going up. And so, it tends to even out over time there. So we don't see as much of the price risk in bonds, particularly in treasury bonds there. But what we want to do, again, is come back to that idea of how many years of distributions do we want to earmark within a portfolio and put them there such that if the stock market does drop, and it goes down, let's just say, heaven forbid, we have another pandemic. It drops by 33% in 30 days, just like it did in the midst of the COVID lockdown. Well, at that time, we want to be selling from bonds for those distributions. We don't want to be selling from stocks. We don't want to sell in a fire sale. What we want to do is be able to say, okay, time to sell some U.S. Treasury bonds that have held their value. Let's give the stock market time to recover. And then at that point, let's rebalance the portfolio, take distributions from stocks, do what we need to do thereafter. But that can help to mitigate some of the impact of a sequence of returns risk where we might be selling stocks into a downturn for the first 3, 4, 5 years of retirement. It doesn't completely mitigate it because if you get zero rate of return for 12 years in a part of your portfolio, it's not going to feel good and it's not going to be probably in line with a lot of those outcomes that we're hoping for in your financial plan. However, it also mitigates the worst of the outcomes, which is, hey, the portfolio drops 50% and now I'm trying to sell to get the distributions I need for Thursday night's dinner.
Right.
Not a good outcome there.
Right. Okay, so the last one that we really haven't talked about very much is alternative investments. We've talked about some annuities, some CDs, bonds, ways that you could move investments so that you have maybe a little bit more certainty for that income. Talk us through alternative investments and how this could play a role and mitigate some of that stock risk.
Yeah, so we think about the other options, and we've talked about bonds, we've talked about CDs, we've talked about, ways that we can kind of stabilize a portfolio. Of course, we even mentioned that you could purchase an annuity, there and have a guaranteed lifetime income stream. There are lots of different ways that we can kind of stabilize that portfolio. Alternative investments are one of those because they have a different sequence of returns typically than what we see in the stock market. Stock market is typically tied more to the economic prospects of a particular nation and the profitability of their companies, whereas alternative investments, they can be tied in some ways to that. Some of them, if we look at private equity, for instance, It would be one alternative investment that would be more tied to, say, the economics, generally speaking. But when we look at some others, reinsurance, for instance, would be one that it's more tied to what's going on in the insurance landscape with natural disasters and things like that. For instance, with reinsurance, we're kind of investing right alongside insurers, and we're basically being able to participate in some ways in the premium that's paid, and we're responsible in some ways for the claims, that come in as well in certain types of reinsurance. So that is quite different. The likelihood that a hurricane hits Miami head on, Category 5 hurricane hits Miami head on, it's going to happen at some point. There's going to be significant losses there at some point. But it's unlikely that that's going to happen at the same time that we have the global financial crisis, starting to really take effect of the entire world. Again, they could come at the same time, but they're likely to be not correlated there. Another would be direct corporate lending. So, this would be lending to private companies. It would be tied a little bit to the prospects of the economy, but generally speaking, this is going to be loans of a private nature that have a much higher interest rate than what we would see in publicly traded bonds. And, over time, if the last 20 years is any guide, we may see a rate of return that is similar in direct corporate lending as we see on the equity markets side of things. So in that sequence, if we look at direct corporate lending, of course, we don't have quite the same liquidity that we do in publicly traded stocks, but we also don't see the same volatility there. So we're sacrificing some liquidity, but we may have the same rate of return, and we might not have the same ups and downs in that same sequence. So alternative investments, whether it's direct corporate lending, whether it is reinsurance, real estate investments would be another one. Real estate investment trusts or private real estate would be another one of those that you may see rates of return that would be comparable to stocks. But because they're tied to real estate and particular properties, there's a tangible asset that is there. And there's also other dynamics. Sometimes those are tied more to interest rates. Some of those are tied more to what's going on in the real estate market in terms of whether they can be sold as properties. So there's trade-offs there, but their returns are not going to align in lockstep with the stock market, so that diversification there of alternative investments can be a nice stabilizer in a portfolio as well.
Right. Spencer, thanks for walking us through all those different considerations when we think about, are stocks too risky for retirees in retirement or as they approach retirement? Clients, if you have questions about this, if you want to discuss the number of years of fixed income distributions within your portfolio, we would love to have that conversation with you. Like we say every time, take this to your financial advisor to talk about what are your risks. What is your sequence of return risks? Should you increase your allocation to stocks? Should you decrease it? Don't take what we said and just automatically go act on it. But leave some questions in the comments below if you have any, and we'll see you next time. If you like these financial planning videos, please share with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.